Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from ChartsandMarkets.com runs down the major markets. He tells us the stock markets tried to pick themselves up. Gold had a great week, crude was up, and soybeans are booming. Founder of TheTrendLetter.com, Martin Straith weighs in on the economic impact of Justin Trudeau's resignation as Prime Minister, his poor economic record of the past 9 years, and what we might see once Donald Trump officially becomes president again. Publisher of the Campbell Real Estate Timing Letter, Robert Campbell, joins us from San Diego to chat about the state of real estate in California and the U.S. in general. He says even though people are leaving California, home prices there continue to escalate. We'll talk to Ross Clark right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from ChartsandMarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on X at Charts by Ross. Welcome back to This Week in Money.
Pleasure to be with you, Jim.
How would you describe what happened on the stock markets this week?
Yeah, well, they tried to have some life and decent bounce at one point during the week, but by the time we finished it off, the markets are looking pretty, at least the equity markets are looking pretty heavy in here. We've been watching this S&P, the big cyclic turn. It looked like we were going to have this classic rolling top as far as the markets were concerned. So NASDAQ was the first one to top out and then came back to retest its high here in the last month. S&P has been doing a roll. It's been down, I guess, 3 times and tested support. Now it's got sort of a head and shoulders top pattern. And as of the end of the week, it's a bit of a Wile E. Coyote moment where it's just over the edge of the cliff, but on the verge of breaking. So we'll see if there's any support underneath here. But S&P is down roughly 5% off its high. It's sitting, as we like to look at the 20-week moving average, which should be providing support in an uptrend. We've tested that, bounced, and come back down again. But as of Friday, we're just on the precipice, and if this gives way, and I think there's a pretty strong probability of that, then the next support is down around 5,500. We are at roughly 5,800 right now, so that would put us down 10% off the high, which is very, very normal in a normal bull market move. If we get down that 10%, then we'll be looking for a short-term buying opportunity, maybe for a good, solid bounce back. But keep your don't hold your breath for that one at this point. I think the opportunities, there's other areas right now. If we take a look at it, the energy markets have really come to life here. We were looking for a seasonal turn. It's in place. You got crude oil up to 76.70 as of this week. Been a really nice move since the third week of December. The stocks there, you take a look at the XLE, the ETF of the stocks, that had a good capitulation low for us back at 83 to 84. It's traded up to 90 as of today, so nice big move as far as that one's concerned. Natural gas and gasoline are doing well, and we finally started to see this gasoline market break out of a decent-looking base. So that whole complex there, it looks as though it's got some definite power to the upside.
What's going on with gold?
Gold, a great week there, 2,690 to finish off the week on the spot price. good oversold reading here about 3 weeks ago, and it's held well at that support. We've been viewing that as a really critical level, the lows of the last couple of weeks, and it became a spot to raise your stop losses. At this point, we'll see how far it wants to go, but it's got reasonable momentum. The silver has been trying to move along with it, but it really has been a laggard in here, so we'll see what happens there. But at this point, it would look to be something as far as the gold's concerned that you can be long, but for traders, you want to make sure your stops are reasonably tight. The best support is still well under here. If we were to get down and test the 50-week moving average, I would really get excited about that if it were to happen once we get past the seasonal uptrend here and get a decent correction.
What's happening with the U.S. and Canadian dollars?
A lot of action there this week. The early part of the week, U.S. dollar took a bit of a haircut. We had been up around 109. We broke hard. It was interesting at the action in the Canadian dollar. Everybody got excited when Trudeau announced his resignation on Monday, and the Canadian dollar rallied. But the rally there was all part and parcel with what was going on with all the currencies. The dollar index pulled back to its 20-day moving average. The Canadian dollar, the peso, the euro, the British pound, they all rallied up to their 20 days and have faltered at that point. So it looks as though the dollar index rally is sort of long in the tooth right now. The pattern development we look at in the trend is fully developed on the upside. So any negative news is going to probably take us down to the support at that 20-day moving average there, which would be bullish for the other currencies. So I think that's going to be one of the better opportunities here in the next few weeks, looking for, say, a top in the dollar index and a bottom in these other currencies.
Now, on the commodities market, apparently soybeans are enjoying a good run?
Soybeans, we got a nice basing pattern in there in the last couple of months, and the beginning of the month here, we saw this as having completed a base, had its first decent run off the bottom, got overbought, and it looked as though you could buy it on a pullback to 990, and there's an ETF in there as well that could have been bought on the pullback. This week, they got right into the price levels for both of those that we had recommended. And then at the tail end of the week, we rallied and closed off at the best level that we've had in a couple of months. So looks as though, there are some of these areas that are showing life, and the soybeans and the energy market are two areas that if anybody likes to be long rather than short, those are opportunities for them.
Ross, thank you so much for being on This Week in Money.
Good to be with you, Jim.
My guest has been Ross Clark from chartsandmarkets.com. You can find him on X at Charts by Ross. Coming up, Martin Straith, next on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Martin Straith, founder of Trend News Online at thetrendletter.com. He's speaking to us from Coquitlam, BC, which is just east of Vancouver. Welcome back to This Week in Money, and Happy New Year.
Happy New Year to you, Jim, and to all your listeners.
Justin Trudeau has just resigned as Prime Minister and leader of the Liberal Party, although the resignation doesn't take place right away. What does his intended resignation mean for the Canadian economy?
Well, yeah, he certainly left his mark, didn't he? By pretty much any measure, Trudeau's last 9 years has left Canada in a terrible position economically. If you look at GDP per capita, as of 2023, there was a significant disparity between GDP per capita in Canada versus the U.S. In Canada, now these are both in U.S. dollar terms, GDP per capita was $54,000. In the U.S., it's $77,000. That means the average economic output per person in the U.S. was 43% higher than in Canada. I mean, you think about that. And in 2014, so just before Trudeau took power, Canada ranked 13th of the 30, OECD countries for GDP per capita. So we were in the top half. And now after 9 years of the Liberal government, Canada ranks 27th, third worst, and we continues to decline versus the other countries. So, I mean, that's an amazing decline for that. And when you think about that, what does that mean? Well, when you combine that with low wage growth, our higher taxes, we've seen this dramatic decline in the standard of living in Canada versus the U.S. over those last 9 years. And then you look at, Stephen Poloz, the former Bank of Canada governor. He says Canada is now in a recession. We've seen the Canadian dollar drop now to a 20-year low. It's below 70 cents. It's at 69, what are we looking at? 69.30 here today. Housing prices out of control. CTV News, I just saw this. In Vancouver, to buy an average price, you got to remember, home, you need to earn $214,000. In Toronto, it's $195,000. And this one is, in Vancouver, you need more than 100% of your earnings in order to be able to buy that house. So, I mean, it's unrealistic. The most painful thing to me over the last 9 years is that Canada, which is this, country with, remarkably rich natural resources and, home to some incredibly talented people, we should be one of the richest countries in the world based on our natural resources. But, this government for the last 9 years, they've done everything in their power to keep those resources in the ground. I'm sure everybody remembers, but Trudeau made some really telling comments. You remember when Germany and Japan, they came almost begging Canada to ship them natural gas. And Trudeau said that there wasn't a strong business case for natural gas. And then soon after that, he committed $43 billion to subsidize foreign automakers to build EV battery plants in Canada. I mean, $43 billion, we got about 40 million people. That works out to $1,075 per Canadian that we were giving foreign automakers in order so that they would build plants in Canada. So you have to, what was the business case that justified that expenditure? We also, the other great quote he had was, he doesn't think about monetary policies. He only cares about families. I mean, as if families are not affected by monetary or economic policies. So what does his resignation mean to the Canadian economy? Well, I think it means, we need to see a major shift in policy that aims to improve our economy. We need to encourage foreign and domestic capital to invest in Canada. And we need to remember, it's not just Trudeau, but the whole Liberal Party has backed all of his anti-business measures. So I think it's going to be really a big problem when we see all these elected politicians, especially those who have been in power for so long. I think they believe that taxpayer money is actually their money. When Trudeau and Freeland were promoting, that they were going to give us, a little treat at Christmas, I think they actually believed it was them, those two people, giving us minions, an allowance so we could buy ourselves some little treat at the holiday. And that a holiday gift, that added $6 billion to the deficit. And by the way, that came in at $62 billion, 50% higher than they said it would be in May. I mean, you think about that. They forecast in May a $40 billion deficit. 5 months later, it's $20 billion higher. I mean, it's amazing. So, it's just been one mismanagement story after another. So since taking office, the Liberals, Trudeau and the Liberals, they doubled our national debt. It was $600 billion when he took over, $1.2 trillion today. So we've got Trump coming in, and it's going to be very interesting to see how the Liberal Party reacts. They can wake up, and do an about face and understand how important the economy is to our standard of living, or, they can just continue to go down this path and, blindly destroying the economy with policies that hinder economic growth. If they don't do a drastic shift in policy, and even if they do, probably the Conservatives are going to take over, and hopefully they can right the ship here.
Speaking of ships, Europe really needs natural gas now with Ukraine shutting off the Russian pipeline to the rest of Europe. And again, Germany and other countries asked for our natural gas. We offered hydrogen, which nobody's using right now and is terrifically hard to transport. Should we ignore Quebec's objections to pipelines, even though they have a love affair with SUVs and suck up more energy than any other Canadian, and push these pipelines to the East Coast or even to Churchill and get our natural gas to the rest of the world? Because they've turned to coal instead of using natural gas. If you want to help the environment, I think natural gas is a lot more helpful than coal is.
Yeah, well, absolutely. And again, like you say, no business case for natural gas. I mean, just everything you just said there is a business case for natural gas. And we have a ton of it. We've got all of these resources in the ground, and this government over the last 9 years has just not allowed any of it to get out to market. And our country, everybody complains about the healthcare system. Like, it's a 6 months to get in to see any specialist. There's all these things. We need all of these things and to improve the social network and so on. And yet we just shut ourselves off from what we're really good at. We are very good at mining. We're very good at, exporting oil and extracting natural gas. And, what are we doing? We're now just about to have our first LNG port. After all these years, it's crazy. And then you look at what the U.S. is doing, what Australia is doing. They're all pumping this stuff out. And for some reason in Canada, we think that we shouldn't be doing it, and we're saving the world here. I mean, what is better that Saudi Arabia pumps up the oil? It's better that South Africa is with child mining, labor camps, getting the cobalt. It's just insane. Like, our mining industry is one of the best, most efficient in the world. And here we are, still these companies have to go through so much permitting and so much, red tape. So hopefully, like your question was, what does it mean that he's left? Hopefully, the door now open. People start to realize, like, our economy, our standard of living has just been tanking, and somebody better start turning that around.
Just one typical LNG tanker carries more than $205 million worth of product. That's a bit of royalty that would be going to the government, isn't it?
Yeah, well, that's just, it's almost like they say, no, we don't need this. It's crazy. But, as you say, he's leaving. Hopefully we can, turn a corner here and try and recover. Like, we've fallen so far behind, but, we need to start turning this thing around.
President Trump takes office in 10 days. What do you see ahead for the stock market?
Yeah, 10 days away from the Trump effect. I mean, I've heard all kinds of terms, the Trump bump, the Trump effect. But, I think there's so much optimism that Trump's going to come out a blazing here, making dramatic changes. And I certainly believe he's going to try that. But I'm just not so convinced that he's going to have success implementing these changes, and certainly not as quickly as he hopes to. The stock market is looking very dicey right now. We've been highlighting to subscribers how the S&P 500, dropped below its uptrend line, and it's been unable to break through that since back in August. So, since August, it's actually been trending lower. So you have to start thinking about that, and it's been trending down here, so we need to see if we can rally back above that trend line. To do that, it would have to rally through the 6,100 level, and that would be about a 1,300 rally from here. Now, today, we got the U.S. non-farm payroll data, and it was a huge beat, 256,000 versus the estimate of 156,000. By the way, Canada also had a big beat, 91,000 versus a 21,000 or 25,000 estimate. Now, to be honest, Jim, I don't pay much attention to these numbers because they're constantly revised. I mean, you look at these estimates, 25,000 job estimate in Canada, and it comes in at 91. Like, who's making these estimates? But even though I don't, give it a whole lot of weight, the market reacts to it, and we see these quick reactions to it. So we need to pay attention. So with a strong payroll data number, and a drop in the U.S. unemployment rate, the bond market sold off. And what that means is the yields spiked higher. So that caused a big sell-off in the U.S. stocks. S&P was down about 100 points earlier. Right now, as we're getting to close here, it's down 90 points. The stock market wants lower yields, meaning lower interest rates. So today's action is not what the stock market wanted to see. So the 10-year, U.S. 10-year is now backing up to the 5% level. So that's getting pretty high again. So we've been highlighting how the S&P 500 has been forming a head and shoulder pattern and warned that if that right shoulder, obviously I can't show anybody this, but they can go onto our website, our blog. I've got a nice blog up there that shows it. The right shoulder breaks down below the neckline, then we're likely to see further declines. Well, today that right shoulder did indeed fall through that neckline. So we're going to continue to watch this closely. But, higher interest rates hit the growth stocks the most. And, we've got the big tech stocks. They're struggling here. And given that they've been the driver of this bull market, their struggles are putting pressure on the whole market. So now your question was related to Trump. So this market is not doing what Trump wants. So I'm going to be watching closely how aggressively he presses the Fed to cut rates. We know he wants much lower U.S. dollar, and he wants U.S. exports to be affordable to other countries. We also know he loves to use the stock market as an indicator of how well the economy is doing. So you got strong job data, you got rising rates, you got a declining stock market. You know that Trump's going to want to change this trend. And so the question is, what's he going to do? So if he forces Powell to cut rates, that's going to be inflationary. So right now, we're expecting to see the tech sector selling off. This market could roll over. I mean, we could see something similar to what we saw in 2022, where we saw a rotation out of the growth stocks into the energy sector. And I think we could see a similar rotation this year. So we're watching this very closely.
Trump's new Treasury Secretary says he wants to reduce the deficit, and the Department of Government Efficiency team, DOGE, wants to reduce the size of government. It's led by Elon Musk. How successful do you think it'll be?
Yeah, well, that is the big question, isn't it? I mean, we know they want to reduce the deficit and the size of government, but will they be able to actually accomplish that? I mean, that's the, $36 trillion question. The Biden administration has already spent $624 billion in the first 2 months of this fiscal. Their fiscal started in October, November. So if you extrapolate that out, you're looking at a $3.5 trillion deficit for that fiscal year. So that's hardly a reduction in the deficit. So every election year, we hear lots of campaign promises, but rarely do we see big promises kept. So in the U.S., there's been numerous attempts at cutting government waste. In the 70s, they had that thing called the Golden Fleece Awards. That's what it was, and it highlighted government spending, wasteful government spending. And I remember they found one example was a $3 million studying why people fall in love. There's a good use of taxpayers' money there. But while it did highlight waste, nothing was actually done about it. And then we had Reagan in the early 1980s. He formed this Grace Commission, and it identified, half $500 million in waste, but its bold recommendations to cut that waste were never implemented. And that was primarily due to political resistance and that ingrained way that governments work. And then we had Bill Clinton. He also tried, but again, very little was achieved. Now, although I'm skeptical that the Trump team will have any more success, given how so many politicians benefit from these wasteful programs, I mean, I would love to see it happen. Bureaucracies are so inefficient, and they're so deeply entrenched with so many regulations and rules. These agencies, their primary goal is survival. It's not efficiency. So they're full of outdated processes, and there's just so much duplication. So trying to streamline all that with all the pushback they're going to get, I mean, I think that's going to be a really daunting task. Now, here in Canada, every year we see so many examples from the Auditor General of these horrific wastes in government spending. And again, every year, the government does nothing about it. So while I hope, they can make some serious headway, I really doubt they're going to make much at all. If they run it, they're going to run into roadblock after roadblock. And I truly wonder how long Musk is even going to hang around. I'm not trying to be so pessimistic. I'm just trying to be realistic here. Other than Milei in Argentina, I think he's the only government that has really seen some serious cuts in government spending. So I guess it's possible. If you have a thick enough skin. My guess is that after a month or two of banging his head against the wall, Musk is going to move on. Call me skeptical, but maybe hopeful. How about that?
Yeah, I remember one of the best examples of government waste. The Pentagon was paying $1,200 for each optically guided kinetic connecting device. You would pay $12.95 at Home Depot for a hammer, which that is.
Yeah. Well, there was a site, I can't remember the name of it, but it's just lists every year some of the most outrageous things. And yeah, the military is certainly right at the top of the list of, just insane amounts of money to spend for, like you say, $1,200 for a hammer. Come on.
I think it was $800 for a toilet seat. Again, they had some fancy name for a waste restraint holding device or something. Anyway, you posted on a blog Tuesday highlighting how NVIDIA had an outside reversal day and how that could be a warning. Can you explain?
Yeah, that was quite a move. So on Monday, NVIDIA closed at, I think it was 149. Then on Tuesday, it spiked at the open, and that was primarily due to they made this announcement of this new tiny super AI chip called the GB10. So that move topped, a 3-session $20 run, and it gapped up to about $154. But then the stock plunged about $13, and it closed below the previous low. So on the same day, think about this, on the very same day, it opened to a new all-time high, and then it fell and tested its 50-day moving average support. So that was the biggest single-day decline in NVIDIA's 25-year history. So what does that mean, you say? So, well, to me, it means that NVIDIA is at risk of breaking down. And we could see it rally after that big drop, but I'm looking at it right here today, and it's down about 3%. Now, if it does bounce, which it could, say $5 or $6 on Monday, but if it then falls back, that would be very negative. We have to remember that NVIDIA and the semiconductor sector, they've been the market darlings. If NVIDIA rolls over here, that could spell real trouble for the whole equity market. If you're looking at another Mag 7 stock, look at Apple, it's also sending out warning signals. Apple's down about 8% the last few weeks here. So you got NVIDIA with a market cap of $3.2 trillion. You got Apple with a market cap at $3.7 trillion. Now, if these two monster stocks can't catch a bid here, then that has got to be really worrisome for the equity markets, at least in the short term. And if you add to that, NASDAQ is just right now, I'm looking at, it's testing its 50-day moving average as well. So, we got to keep an eye on this stuff, because what we're seeing as the market rallied, that it kept closing at the daily high. So on this whole run up, markets kept closing on the daily highs. What we're seeing now is that these stocks are closing on daily lows. So we need to pay attention to this. When the most popular stocks and sectors start to close on the lows, and if that pattern continues, then we need to pay attention, and you need to start to think, about taking some profits, or at least looking to apply some hedging positions to protect your portfolio.
What do you see for the currency markets? You had been warning the Canadian dollar was going to fall below 70 cents American, and it did. So what do you see now?
Yeah, well, when we look at currencies, it's all connected. So if the U.S. dollar is rising, most other currencies are falling. Well, the U.S. dollar has just been on a tear here. So, it's at a near 2.5-year high, and it's up almost 10% since early October. That is an absolutely wild rise for any currency, especially the world reserve currency. So why is the U.S. dollar being so strong? Well, The U.S. bond market is paying higher yields than most other bond markets. The U.S. stock market is by far outperforming European and Asian stocks. The Fed rate is 4.5%. Well, that's 1.25% higher than in Canada. So if you're a bond investor in Canada, do you want to buy a Canadian bond or do you want to buy a U.S. bond? You're getting, 1.25% more in the U.S. It's also 1.35% higher than the ECB. So you've got foreign investors, look at, if you're a European foreign investor and you want to invest at the better returns in U.S. stocks and you want to buy them instead of your domestic stocks, well, to do that, you need to, convert your euros into U.S. dollars to buy those stocks. If that same investor wants to buy U.S. bonds that pay a higher yield than their domestic bonds, well, same thing. He's got to convert his euros into U.S. dollars. So that just creates a much more demand for the U.S. dollars. It's not rocket science. So each time a European investor or a Japanese investor wants to invest in higher performing stocks or bonds, they need to convert their euros or their yen, and they need to buy U.S. dollars to buy those stocks or bonds. Investors, they put their capital where they feel they're going to get the best return. Now, one thing we want to keep an eye on here is both Trump and his secretary, our Treasury Secretary, Bessent, they want a weaker U.S. dollar. So we're going to be really watching to see if they're going to try and force the Fed to cut rates, because that could be a game changer. Now, for Canada, for the Canadian dollar, things are looking gloomy. As we just said, it's trading at under 70 cents, and it's just been going down and down. As we mentioned, Bank of Canada Governor, our former Governor Poulos said Canadian economy is in a recession. Canadian GDP is at 1.2% annual. The U.S. is at 2.8. That's 133% higher. So, as I mentioned earlier, the Canadian GDP per capita is over 42% lower than the U.S. So since late September, the Canadian dollar is now down about 4.25 cents, and that's about 6%. So as I say, sitting at 69.30 today. But when Trudeau announced he was resigning, the Canadian dollar got a little bit of a bump, but it didn't last too long. So we're going to be watching to see if Trump repeats his first-term policy of wanting to get lower U.S. dollar. Back then, Trump was constantly pressuring Powell to lower rates, wanting to make the U.S. exports more competitive and to boost U.S. stocks. But if inflation keeps rising, and it has been lately, it's going to be tough for the Fed to cut rates aggressively. The Bank of Canada, on the other hand, it needs to fight a recession now. And so it's likely going to have to keep cutting rates more. So, that's going to keep the Canadian dollar lower. Now, long term, if we get a much more business and economy-friendly government, then there would be hope for Canada. But, it's not going to happen overnight. And, but first we have to deal with Trump's tariffs. Then we have to have a Canadian election. And then maybe, if all the right things fall into place, there's some hope at that point. The previous all-time low for the Canadian dollar was 62 cents. If Trump imposes a 25% tariff on the Canadian dollar, that's going to be devastating for the on Canadian goods. That's going to be devastating for the Canadian dollar. We might even test that 62 cent level. So, stuff to keep an eye on. Bottom line is the U.S. economy is simply much stronger than Canada, most of Europe, Asia, and the rest of the world. And as long as that remains the case, the U.S. dollar is going to remain pretty strong against most currencies.
The last few times you've been on, you called for gold to hit $3,000 in 2025. Is that still the case?
Yeah, well, after the U.S. election, gold dropped, about 8% after hitting, all-time high of 2,800. And then since then, it kind of rallied a bit from that low. At the same time that gold had sold off, we saw Bitcoin shoot higher, as there was all that Trump euphoria about Bitcoin kicking in and, the crypto reserve and all that kind of stuff. So that kind of explained the initial sell-off. But since then, gold has been trading a little bit higher, and it's in this wedge pattern now. And with wedge patterns, what we see is we see the support and resistance level slowly start to, converge. So what we should soon see is whether gold's going to move higher, like break to the upside, or it's going to move lower, breaking to the downside. So we're watching that wedge pattern very closely. So now in the last couple of days, gold has been trading higher. I'm looking at it right here, just near the close on Friday. It's trading about 27.20, so it's up, almost $30. And that's, main reason there is all that jobs data. Inflation is starting to come back into focus here. Also, that 27.20 level that is testing, that is very close to the upper level of that wedge pattern I was just talking about. So if gold can break out of that wedge pattern to the upside, we could see a really nice run here. I really like, what I really like is how gold has been able to hang in there while the U.S. dollar has been so strong. Now, if we see, Trump and, that dissent, if they really do start to lower the value of the Canadian dollar, the U.S. dollar, then gold could really take off here. Now, I believe we're going to see both gold and the U.S. dollar moving higher, especially if we get some black swan event. Reasons I like gold, there's all kinds of them. The BRIC nations are looking to create a gold-backed currency to get off the U.S. dollar. Globally, governments, they have all kinds of fiscal problems. We got huge debt problems in the U.S., Canada, and most of the developed countries. And, it's really important for all your listeners to understand, these debts, they're inflationary, and that reduces the purchasing power of all these currencies. And that's key. So we've got central banks, especially those that don't like the West, with China, Russia, Iran, etc. They're loading up on gold. Now, if we look at seasonality, January through the end of February is typically a strong period of gold. And, in the bigger picture, yes, Jim, I certainly expect that we're going to see over $3,000 this year. And, as I say, it's trading at 27.20. 25.50 would be the next key support level. Now, that level needs to hold because if it breaks down below that, we could see a much deeper correction. Next resistance is 27.40, and then would be the all-time high at 2,800. So again, I expect us to see 3,000 gold and much higher over the next couple of years.
You mentioned before that you were expecting commodities to start to rally in 2025. Which ones in particular, and what would cause that rally?
Yeah, I do. I think we're going to see the resumption of the commodity boom. But first, the key here is we first need to get through that first month or so of Trump and get a handle on what he's going to do about tariffs. Because if he does what he says he's going to do and slaps tariffs on all of these countries, that's going to hurt the global economy, and that's going to likely, see commodities get hit pretty hard. But we know that Trump wants a much weaker U.S. dollar. So if he starts pushing Powell and the Fed to cut rates and he weakens the U.S. dollar, well, then, commodities should rise. Now, there's a number of sectors I like going forward, and we'd be adding to our, portfolios if we get our modeled buy signals. But as I say, one of the biggest drivers will be a weaker U.S. dollar. Now, if the dollar does get devalued, and the commodities do not rally, well, then that would be really bad news for commodities. But I think it's going to happen. And if it does, I really like copper. I think copper is going to do really well. I think, you got China. I mean, obviously that would be a critical player in any commodity boom. But I think, the Chinese government, I think they're really going to add some stimulus. And one of the things about China is that they've got a lot of reserves. They don't need to issue a whole bunch of debt to fund their stimulus programs, like the U.S. and Canada and most of the Western countries do. And a key reason why I like copper is that the demand will continue to grow. The supply is constrained. Copper will do well even without electric vehicles, even without, AI data centers, even without renewables. Demand continues to grow without all those. And those factors will just add to the demand equation. So I think copper may have bottomed here, just under $4. And I don't think it's going to have any major decline, again, unless Trump goes crazy on tariffs. Another commodity I like is uranium for the long haul. The fundamentals there are excellent. We've got 440 nuclear reactors in operation right now, globally. 65 are currently under construction, and there's about another 110 in the planning stages. Now, we have to remember that last year at the, the COPs, whatever summit, 28 summit, I think it was, we had 20 countries, including U.S., Canada, UK, France. They signed a declaration to triple nuclear energy. So, I mean, if we just do the math, if you currently have 440 reactors, if you're going to triple that, well, that would take it to 1,320. Now, if you've got 65 under construction, 110 planned, you still need 1,145 to meet that target. Now, we know that at these climate conferences, they always make these very unrealistic targets, but even if they only build half that number, there would still be a huge need for a lot more uranium. Now, while I do like uranium long term, I still think copper has the biggest potential for the best results later in 2025. And as I noted earlier, we're anticipating a rotation into commodities as inflation pressures sort of continue to mount. Now, if the Trump administration actually cuts government waste and jobs, well, then we would actually see inflation decline. But I really doubt they're going to make the kind of cuts required, and instead they're going to push for more rate cuts, which would add to the inflationary pressures.
When you were on last month, you said Bitcoin was in a near-term uptrend channel, but if it fell out of that channel and below $97,500, it would be vulnerable to deeper corrections. What do you see now for Bitcoin?
Yeah, well, one thing that we've noticed recently with Bitcoin is it has started to move with the stock market more than ever before. And if you looked at a chart of Bitcoin, we can see that Bitcoin has fallen out of its uptrend channel, and it's now trading at 94K, here on Friday. So that's below, like I said, I was talking at 97.5. Well, now we're at 94. Now on the chart, what we've got, I drawn a line here. We have very strong near-term support at the 92K level. Now, to get back into that uptrend channel, Bitcoin would have to rally, to over 104,000. So that would be another 10K from here. Now, which given its volatility, that's certainly possible. But if Bitcoin falls below that support at 92K, that really opens the door for a much deeper correction. Now, we got Trump taking office in 10 days, and then we could certainly see a rush into Bitcoin if the market feels that Trump's going to act quickly and, reduce regulations for crypto and make some sort of announcement about a crypto reserve. But at this point, if we base on the technicals, and that's what we do, Bitcoin is more likely to head lower than higher. Now, if it can rally back to that uptrend channel and break above its upper rung there, well, then Bitcoin could move on toward its next destination of 200K. While a break below, though, that would cause a significant sell-off in Bitcoin. Really, I could easily see Bitcoin sell off here on Trump's inauguration. I really think that we're probably sitting here with a situation of the, buy the rumor, sell the news situation. All the good news is very likely built in, and I think Bitcoin may be in for a real drop here. I wouldn't be at all surprised. We've got support here around the mid 70,000 level. So while we're watching Bitcoin for a likely spike lower, we still see the potential for that January rollover that we discussed in the stock market. And given that, as I just said, we're starting to see Bitcoin kind of move more with the stock market, that just kind of adds fuel to a likely decline in Bitcoin for a while. So we'll be watching this closely. If we do get a drop into that mid 70,000 level, that would very likely trigger a buy signal in our models.
What do you see ahead for crude oil?
Well, ever since oil hit around that 72.5 around the U.S. election, at the time we warned that it was likely going to drop below 70 and very likely test the 66 level. And since that time, it did exactly that. It dropped below 70, tested 66 support. And that was the fifth time that it tested that support level since September. And each time it is held. So that is an incredibly strong support level. Now, it's rallied off that support. Here today, it's trading at, 76.20 here on Friday. So oil's been trending higher in the short term. It's pushed through our near-term resistance level that we had at about 73. Today, we got that much higher U.S. job data coming out, suggesting inflation is rising. Plus, we got news that the U.S. is looking to increase sanctions on Russian oil. So all that kind of combined, we pushed through that 74 level, which, by the way, that was our initial target high for oil in the near term. So we just surpassed that. So we need to watch this closely. So oil's done well here, especially with, given the strength of the U.S. dollar. Now, based on seasonality, January is usually a quiet month for oil. So, the real seasonal strength doesn't usually start until we get into February. So, we're sitting here at 76.20. I'm watching this close because unless we get some kind of geopolitical event, escalation in the Middle East, Russia, Ukraine, that kind of thing, I suspect we're getting very close to a near-term top here. So, like I say, near term we should be topping out. For your listeners, the areas in the oil sector that we're interested in, realistically, we really like the exploration and production companies and the pipelines.
Can you tell us a bit about your four services, Trend Letter, Technical Trader, Trend Disruptors, and Headlines, and how listeners can get more information?
Yeah, well, we got the Trend Letter, so that's in its 23rd year now, soon to be 24th, actually. Weekly publication, long-term investors who want to understand what's driving the markets. And it covers all the sectors, so equities, currencies, precious metals, commodities, and bonds. Trend Technical Trader, online service, it's updated every Monday, Wednesday, Friday. It's for both active and longer-term investors. It used to be, we started it as a hedging service, but now it also does long positions. And again, it covers everything, equities, precious metals, commodities, etc. It includes our proprietary gold technical indicator. And then we have our trend disruptors. So that's for speculators, with risk capital available. So this is, very speculative sectors. Service invests in disruptive ideas. So we're talking AI, virtual augmented reality, 5G, cloud, Internet of Things. So all the cool stuff. And then we have Headlines. So that's our free daily service. So what we do there is every weekday morning, we review what's happening in the markets, and then we send out the headlines that we think investors need to be aware of. And then readers can simply read the headline, and if they want the details, they can just click on the link and read the actual article. So, listeners, they can go to thetrendletter.com, check our blog page. We do updates up there, a couple times a week. So again, thetrendletter.com. If any of your listeners have any questions about our services or what's happening in the markets, just email us at info@thetrendletter.com.
Martin, thank you so much for being on This Week in Money.
Hey, Jim, always a pleasure.
My guest has been Martin Straith, founder of Trend News online at thetrendletter.com. He was speaking to us from Coquitlam, BC. Our conversation took place on January 10th. Coming up, Robert Campbell next on This Week in Money.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. My guest is Robert Campbell, publisher of the Campbell Real Estate Timing Letter. His website, realestatetiming.com. He's speaking to us from San Diego. Bob, welcome back to This Week in Money, and Happy New Year.
Oh, Happy New Year, Jim. Thanks for inviting me back.
When's the next issue of the Campbell Real Estate Timing Letter coming out, and where can people subscribe to it?
It'll be published around the middle of January. And I publish it every 2 months, so these are exciting times, and I enjoy publishing.
Can you tell us about your book, Timing the Real Estate Market, and where our listeners can get it?
Yeah, I wrote that book in 2002, 23 years ago. I've updated it. I'm on the 5th edition right now, updating it to show that the five indicators that I use to forecast real estate trends continue to be accurate. Because you go back 40 or 50 years, those key indicators, they correctly follow the market, the price movement by over 80%. So it's really good. It really works well. And so that it's really a big advantage, and it's all data oriented. Strict. I put it in a model, 5 key indicators, and so it's just really, really interesting. I'm starting my second book though. Since I first published that book, I've doubled or tripled my knowledge, and I need to put in a book and share with everybody what else I've learned. But it's a fascinating study. It really is. I mean, it really gives you a feel when you understand real estate cycles. That now you understand. Okay. Look, there's a time to buy and there's a time to sell. There's a natural rhythm to this kind of thing. That's the way life works. Real estate goes up, it goes down. Up, it goes down, just like stock market or any other asset class. Real estate, and so if real estate's your thing, and most people have to own real estate, a house or something, if you're going to buy, the best time is to buy it when prices are low and sell it when prices are high. Or stay in it, but at least buy it when prices are high. When prices are low, then that can be the foundation for your financial wealth for the rest of your life if you allow it to be, because it'll be a really super good investment for you. So timing's important.
The Fed meets again January 28th and 29th. What do you think they're going to do?
I haven't seen what the betting line is on it, Jim. Now you can officially bet on this stuff. But I would say they're not going to drop, and they'll probably just do nothing. They've already dropped it. 3 times since mid September, half, and a quarter. So no, I don't think they will. I think they'll do nothing this time.
Well, I think they said at their last meeting that although they said they were going to do 4 cuts in 2025, it's down to 2 cuts.
Okay. Well, they change all the time. It's like so how can you and it was 4 cuts, now it's 2 cuts. So how can you believe anything they say? Obviously market conditions, economic conditions have changed for that comment, but that could be just as easy, and they go, yeah, in the next meeting, yeah, we've revised our meeting, there's going to be 3, 3, not 2. So it's nothing you can trade on and make money. You just have to realize, okay, what's the overriding picture? They're trying to, they say inflation's down so they can cut interest rates, which is true. They can cut interest rates. The problem is that the government's measures of inflation, their inflation numbers, are incorrect. They're too low. So all of a sudden I say, yeah, inflation's 3%. It's probably 6%. Okay, so should we be lowering interest rates? No, we should be raising interest rates. So that's the metric right there. The government's measure of inflation is bogus.
What's the bond market predicting for mortgage rates?
Higher. Ever since the Fed dropped cut rates 3 times in the last 3.5 months, long-term government bonds and mortgage rates have both gone up more than 1 full percentage point. So the bond market's doing something totally different than they would have expected. So why is that? I think it's more than just inflation. I think that what the bond market is sensing is Donald Trump is a big spender. He always has been. He is a big money guy. That's his ego. And so he's going to do amazing things, with the economy. He might even drop interest rates, but the spending isn't going to go down. It's going to go up. And the bond market is sensing that, and that the fact that it's going to increase the debt by continual law, but also rising mortgage rates. It's going to undermine the dollar. It's going to undermine the dollar and the confidence in the U.S. government, and therefore, and the people that own these securities, they know that interest rates are likely to go up, not down, regardless of what the Fed says. And so the market's reacting to that, and that's what I said. There's a good chance that that's the case. Trump's a big spender, more debt. He loves debt. He loves debt. So expect even more of it coming out. He's dropping about the Social Security, nobody pays tax. He's talking about dropping taxes while he's increasing spending. That is so inflationary. Now the tax revenues, are already significantly deficient to cover the costs. So it's pretty amazing that right now that if you take in the United States, if you take Social Security, Medicare, and interest payments on the national debt, those three items by themselves are 3% more than the government takes in tax revenue. So that doesn't even count running the government, giving 20% of their budget to the states. Every state gets funded by the federal government. And so in other words, it's a lot of money. It's $2 or $3 trillion extra that has to be added to the national debt to cover those expenses. That's where we are today. I wouldn't own a bond. No way. That's just as a finance person, the pressure on interest rates is going to be higher, not lower. That's the best bet. So that's why bonds are going down and mortgage. The rate of mortgage, the rate on 30-year bonds is going up as it is for mortgages.
Inflation and the incoming Trump administration, what level of inflation are we likely to see in 2025?
Well, inflation lags, for one thing. It's going to be higher. It's going to be support. Inflation's not going down, guys. It's going up. And I say that because in my readings, of top guys, Milton Friedman, he was always a smart guy. You got to believe something what causes inflation. What causes inflation is government deficits. That's the primary cause of inflation. So as these deficits not only continue, but and maybe even get bigger, that means more inflation. That's the way you have to bet that.
Government deficit spending, do you think the incoming Trump administration has plans to curb deficit spending?
No. As I just mentioned, it's more likely to go up. Now, I guess there are some offshoots of this. Isn't Trump threatening to get out of NATO and all these other, organizations that we're in and financing and just get away with? That would be a cost savings. Just giving money away, to Ukraine and Israel and, all these wars and whatever else they do, for defense and all that, if they would shut that down, that would be money that wouldn't go to the national debt. So that would be helpful. You know what? They're not going to close down wars, guys. Wars, that's big business. There's no way war is going away. Even with Trump, I think he knows that right now. He's not going to shut down these wars completely, even though people would like him to. The military-industrial complex is just too big.
California on fire again this week. Are ongoing fire concerns likely to cause people to move out of California? And the list of celebrities who have lost their homes in the Palisades fire is just incredible. Ricky Lake, Billy Crystal, Paris Hilton, Anna Faris. It just goes on and on. Are these ongoing fire concerns likely to make people move out of California?
I don't think it's the fire concerns. I think that I wouldn't be surprised if people move out of California. That's a continued movement. The people that are moving out of California currently tend to be rich people because they can see and understand what's going on, and they want to get away from this. They have the financial ability to do that, and they're doing that. So I think this will fuel that same kind of movement even more because more and more rich people can clearly see how incompetent the government is. That they can't handle something like this, and that's not something that they approve of. This is just unbelievably terrible. Do a lot to incompetence. So and that can be avoided. So I think that, I don't think it's going to bring people into California. Let's put it that way, Jim.
Is it expensive in California to get fire insurance on homes?
Yes. And that's really interesting. I'm not a conspiracy theorist, but maybe I'll kind of look that direction. Here in California, in the last year and a half, homeowners policies have been canceled. A lot of people left. Allstate, farmers, the big boys left. So that I was with farmers, so I had to we had to get a new policy from Geico that was willing to give us a policy, and the annual fee was double. It doubled from the year before. But I mean, you got to have it, so we have it, right? It's kind of interesting that all of a sudden everybody started canceling these homeowners policies, and now all of a sudden we're having these fires. You know what? So you wonder why they did that. So it's available, but it's expensive, guys. It went up 100% in 1 year. Ours did. So that's a big increase.
What's the latest on California home sales, prices, and inventory?
Prices made new highs. The median priced home in California hit $1 million last month. $1 million for the median priced home. So that means in the state of California, let's say you bought the median priced home somewhere. In the state of California, you buy that home, you put 20% down, and you go out and get a mortgage at 7%. And if you add in property taxes and homeowners insurance, fire insurance, the monthly fee for that mortgage would be $6,600 a month. PITI, principal, interest, tax, and insurance. $6,600 a month. Okay, to make that and that's after tax. To make that kind of money, you have to be making, let's just say, $10,000 a month to net that, to net $6,600. Close enough on this kind of thing. In other words, you have to be making, so $10,000 a month is $120,000 a year. The average, you have to be making $120,000 a year in California just to make the mortgage payment. So let's just say that you're somewhat prudent and you're only going to use 25% of your, or 33% of your, of your take-home pay on, the mortgage. It used to be 28, but now it's up 33. That means you have to be making $360,000 a year to afford the median price house in California. That's how expensive it is. That's why there's been this huge change in wealth. Anybody that owns a home or stocks for that matter is doing extremely well financially. And people that don't own either, they're doing terrible. The latest statistic I wrote about, and I think I'm going to be writing about this including this in my timing letter for January, is that in the United States, the 70% of all people own a home, and the net worth, their total net worth of the people that live in that home is around $250,000. People that don't own a home and rent, their average net worth is $7,000. In other words, people that own real estate, their net worth is 40 times greater than the person that don't own a house. And right now, with property values in the states here at record highs, not only California but the United States, people that own real estate, they've made a lot of money recently, and the people that don't are just getting killed. They have nothing. But that'll change. That variance is almost at record highs, and so a reversion of the mean will bring that back down when housing prices crash. But that's just the current state of the U.S. economy.
Yes, in Canada, they always do a story every year. The top-end CEOs make as much money in the first hour of the new year as you do all year. Yeah,
exactly. So, at that extreme. in other words, what's happening right now, even if you do own a house, you can be struggling because of inflation, because it's such a bogus number that's produced by the U.S. government. It's much higher. But the people at the top continue to do well. The top 10%. If you're in the top 10%, okay, those are the only people that consistently tend to do well, financially, over decades. The bottom 90 are just getting creamed. That as far the standard, the quality of their life is going downhill, not uphill, for financial reasons, maybe for health reasons too. So the key is to get in that top 10%, and to do so takes a lot of work, it doesn't take as much work as you think, because the bar is not that high for being in the top 10%, believe me. That's how poor the rest of most people are. I forget what it is, but I mean even income and net worth, it could be, here in the United States, could be as low as your net worth is like $2 or $3 million, and you make $150,000, $200,000 a year or something like that. I mean, that's still doing really well, but that doesn't. I mean, that'll get you in the 10% club. So if you play your cards right and God's looking out for you, and you make the right financial and health moves during the course of your lifetime, you should be okay. But if you don't, who knows what's going to happen?
How are the other areas of the U.S. doing with home sales prices and inventory?
Well, all my key indicators, existing home sales down in California and nationally. Building permits, we're talking about trends. New home building permits, they're down in California and down in the United States. Foreclosure sales, they are rising slightly, but not much. And mortgage rates, they're up back over 7%. So that's a very negative. However, in studying interest rates, of all the five main indicators I use to track the trend of housing markets, interest rates is the least predictive. Interest rates can go up during rising housing markets, and it's still good, and they can go down during falling markets, and prices keep going down. But everybody seems to be more focused on real estate, like, oh, it's all about the interest rate. No, it's not. It's not at all. I mean, and the data shows that. So all of that, is unfavorable, but prices are still rising, even though the year-over-year growth has gone down the last 5 or 6 months continuously. So the momentum is down, and the reason prices are still rising is there's no supply. There's no supply. The supply of homes on the market is still down. I think nationally it's up like 3.5%, 3.5 months of supply. And in California, it's probably, I forget what it is, around that. Until it gets above 6, that's going to push housing prices higher. That's why I am short-term bullish, because there's no supply available, and I'm long-term bearish, because if you look at the cycles, you can see the cycles repeat over and over and over again, and in so many cases, the curves have turned over that are very predictive, and yet housing prices are still slowly getting higher, and that's all because of supply. But when the supply comes back into the market, which it will, that'll be the sign of the start of the next major downturn, and it's going to be a woozy.
What are some of the best real estate deals you've done?
The best real estate deal I did, so we talk about making money in real estate. Okay. I bought that back in 1992. I bought an expensive piece of property on a 1-acre lot on the first hole of the golf course. And it was a fixer-upper. And I moved my family. No, I didn't move. I spent the next year improving that house, both inside and out. Just totally tricked it out. And I bought that house for $500,000, and I put $100,000 worth of hard costs in. I didn't charge for my own time. I mean, I had I was doing some of it, but certainly not all of it, because a 5,000 square foot house is a big house, and if you did it yourself, my God, it'd take you a month just to paint the thing. So but doing that, and 2 years later, I put it on the market. It was a capital gains kind of a thing. And we sold. So I'm in it for $600,000. I sold it for $1.2 million in a bad market. And that was $300,000 to $400,000 more than the comparables on the street. And it was an expensive street. The average price home was like $8,000 or $9,000, $800,000 or $900,000, and I'm selling mine for $1.2. All my developer buddies said, "Ha ha." I go. I mean, even though they said you'll never get that, you're overpriced. But who cares? It's his money. He can do what he wants. Well, I got $1.2 million, and I made $600,000 in 2 years, and it was all because of the improvements that I made to the house. I know how to trick a house out. I know what looks good, and I know that if you're in a high-end area, you can spend a lot of money on your house, because that even if it's over market, if it's the best house in the whole area, somebody will come along and buy that house because the wife's going to go, that's the house I want. The husband's going to go, honey, it's at least $300,000 overpriced. She goes, I don't care. That's the house I want. And they got the money, and so that the woman makes the choice. And I made $600,000 in a bad market. Because here in California, prices were going down. They weren't going up. None of it was price appreciation. It was all added value. That's my favorite way to make money, guys. They're listening to this in real estate. Add value. So now if you can combine, buying at the bottom of the market when prices are low, and then having a house and the ability to add a lot of value to it during the rising trend, you can really make a killing out at the other end. So, you got to have building skills or know how to do it. But it's not that hard to learn how to build a house, believe me. But that's my favorite way to make money in real estate, and I made $600,000. So in a bad market. So I know, and the woman that saw it. So here's how the offers went. Okay, they knew it was overpriced in a falling market. So it said the first offer came in at $800,000, and I countered back at $1.195 million. In other words, I dropped the price $5,000. They came back and offered me $1 million. Then I dropped the price $10,000. So I actually sold the home $10,000 less than $1.2 million, and they accepted the offer and they closed escrow on it. I know. So that's the most money I made in real estate, and it was all within my control. No price. I didn't need any price appreciation.
Any last words of wisdom for us?
Everybody this year is looking at making money in real estate. And that's why that I do what I do. Everybody wants to make a lot of money in real estate, or some money, or just do well. Okay, that's. But the only resolution that I have for 2025, and it's just a reminder: health comes first. Health comes first. And what I mean by that is that's your most important asset, and it should be. It's not some real estate building, and that should be your highest priority of protecting it. And it's 100% true. So I just remind myself, and that people ask me and say, "Okay, what do you do? What do you do? To stay healthy and stay in shape?" I go to the gym and lift weights 3 times a week, and I go out and take 2 to 3 hour walks with my beagles up and down canyon hills for 5 to 6 times a day, and that cardio keeps me in good cardio shape. So that's what you got to do. You got to do cardio. Cardio is good for your health, and your heart, keeps your weight down. And the weights, what they do is they keep your muscles strong. And I'm talking about they keep your muscles strong so you look good, so you don't look flabby. Who wants to get old and look flabby? And you don't have to do a lot of weightlifting. Just keep your muscles hard. You don't have to be big. Just keep them hard, and that's the way you stay healthy. And you should do that every day. I mean, do something like that every day. First thing I do when I wake up in the morning, guys, is I say, okay, what am I going to do for my health? What's today? Is it gym day? Is it cardio day? And plan my day around that. But it gets done. You do it consistently. And if you do that, it doesn't take that much to be like super healthy. I have a lot of energy, and I'm no spring chicken. Where'd I get all this energy? I'm really in good shape. I'm healthy. I'm optimistic about the future. I like doing what I do, and life is a great adventure that you look at it like that, and it's exciting. And I have the physical health to enjoy the ride. And so everybody should have that. So you got to look after your health, guys.
Bob, where can people follow you, buy your book, Timing the Real Estate Market, and subscribe to your newsletter?
They can go to realestatetiming.com. Just like it sounds, realestatetiming.com. And I have a blog there, too. I write blog posts, maybe 1 or 2 a month. And most people really like it. And so if you want to sign up for that, just to get to know me a little better, you can do that.
Bob, thank you so much for being on This Week in Money.
Hey, it's my pleasure, Jim. Thank you.
My guest has been Robert Campbell, publisher of the Campbell Real Estate Timing Letter, his website, realestatetiming.com. He was speaking to us from San Diego. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Martin Straith, and Robert Campbell. And thank you for listening. If you have any questions for the show or our guests, you can send them to info@howstreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen.